Good morning. It's Monday, November 3rd, 2025. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer. This is my weekly economic and market commentary. You can follow me intra week, should I have something to say, on LinkedIn. Just follow Herb Morgan, or on X at Herb W. Morgan. The presentation you're seeing and hearing is prepared by me for use with you. Doesn't matter if you are a financial advisor or an individual investor. Regardless of which you might be, you are expected to make your own investment decisions. Nothing contained in the presentation should be treated as investment or tax advice. No recommendations are made for the purchase or sale of any securities. Everything is for informational purposes. The views and opinions expressed herein are mine. They may differ from the views of CFIA's parent, affiliates, or other portfolio managers of the firm. Well, we had a mixed week for equities last week on the Fed action, Fed rate cut, and some pretty significant trade developments last week. The U.S. continues to remake its position with its trading partners in the under the Trump administration. Let's start with large cap U.S. It was up. They were up. Stocks, S&P 500 up 0.75%, but mid and small cap stocks both down, and kind of considerably so. Even though there was a Fed rate cut, interest rates kicked a little higher. That sent the aggregate bond index down about 0.6%, and longer dated treasuries down a full 1%, actually a little bit more than 1%. We are still in the midst of a very lengthy government shutdown, so much of the economic data that we like to report to you is still delayed. But there is much that is produced by the private sector and is still available to us. Let's start with durable goods. That is one that is impacted by the government shutdown, so we do not know the September durable goods number. We do know the FHFA house price index in August gained 0.4%. It was expected to actually be down and is up 2.3% on a year-over-year basis. Moving on to S&P Case-Shiller Home Price Index, similar metric, also showed a gain when they were expecting a little bit of a drop, gained 0.2%, and up about 1.6% from a year ago. What this does tell me is that home price inflation, and therefore we can imply owner's equivalent rent, which goes into the CPI and PCE figures, is moderating. It's still going up. Prices are still going up, just by a much smaller rate. We had years where 7, 8, 10% home price increases were the norm. We also got a report from the National Association of Realtors on pending home sales. The number was unchanged, expected to be up 1%. We had a big jump in August that we did not repeat. That's okay. Still about 1.5% more homes in escrow pending than there were a year ago. The Conference Board's report on consumer confidence, just like the Michigan report that we've been getting, continues to trend lower. Most of this, I think, has to do with labor market uncertainty. You could say the labor market's still pretty strong, but there's a lot more uncertainty. We haven't had big layoffs. We haven't had a big increase in unemployment. We think we haven't had a big increase in weekly claims for unemployment, but we haven't got that report for about 4 weeks. But the ADP numbers that we do get on the monthly job adds or subtracts have been very, very small adds the last few months. And therefore, I think people are starting to get a little worried. And of course, just consumer prices, cost of living issues, gasoline, food, healthcare, and the like have got confidence down at a level that's really not much better than it was during the COVID-related shutdown. Within that report, we got the present situation component. It was up a little. Expectations, though, continue to not be particularly good. Weekly jobless claims, as I mentioned, we have not had for some time, and we did not get, and I don't expect we're going to get this week. I think we're in for a long, drawn-out shutdown. We did not get third quarter GDP report. We were expecting 2.8% if a report was issued. We can look at the Atlanta Fed's GDP Now indicator for the quarter we're in, and that's the fourth quarter now, obviously. And that's looking like it's about 3.9%. So for the fourth quarter, that is, things look to be okay. Personal income and spending not reported due to the government shutdown. PCE, very important indicator. This is the Fed's metric. This is the metric the Fed uses, I should say, to determine whether or not they are meeting the inflation side of their dual mandate. They look to get the PCE number down at 2% year over year. You can see we're well above that at 3%, whether it's core or headline. And of course, that number is also delayed due to the government shutdown. Chicago PMI rose from 40.6 to 43.8. Remember, the line of delineation there is 50, so the Chicago PMI is not particularly good. But the bigger news on the week was not just these data releases or lack of data releases in some cases. The bigger news on the week was the Federal Open Market Committee meeting. This impacts all of us. And then, of course, trade policy has a pretty significant impact on all of us. Let's talk about the Fed meeting. The Fed, as predicted, lowered the Fed funds target rate by 25 basis points to 375. This is the second decrease of the year, the second 25 basis point cut. As you would expect, immediately after the Fed announcement, the banks followed suit, lowering their prime interest rate another 25 basis points as well, down to 7%. Within the Fed report, in their statement, there's some notable things I called. Number one, they said growth of economic activity has been expanding at a moderate pace. So despite the fears of a slowdown, we haven't actually had a slowdown. But the gains in employment have slowed and the unemployment rate has edged up. I mean, there seems to be no doubt we're at the early stages of a massive productivity boom that will always have a ripple effect of fear and loathing in the labor markets, right? This AI is all about driving efficiency, driving margins, driving productivity. They also noted, and this was new language, this is very important, inflation has actually moved up since earlier in the year and remains elevated. This is important because remember, the Fed has a dual mandate, inflation and unemployment, not inflation, price stability and unemployment. So, full employment. So if prices are moving up, that would suggest not cutting rates further. But if the labor market's deteriorating, that suggests you should cut rates further. So at the one hand, they say inflation is up. And then in the very next statement, they say the downside risk to employment has risen in recent months. So this is a bit of a problem. These conflict. And when these conflict, what does the Fed do? Which reigns supreme? My view is they're looking at that inflation target of 2 and saying, you know what, if it runs as high as 3, we're going to ignore it and we're going to focus on the employment side. I'm personally more of a hawk, and I think that, the value of currency is important. So we'll see. We'll have to see what goes. And the other thing that was big news is they said we're going to stop reducing our balance sheet. Now remember, the Fed's balance sheet ballooned up to almost $9 trillion in COVID. This is literally that thing when they say they're printing money, more money in circulation if it meets velocity, meaning it circulates in the economy, creates inflation. So once you get past the problem, which was COVID, they began to reduce that balance sheet. So they have de-printed money north of $2 trillion. But the balance sheet itself is still absolutely massive, just under $7 trillion. And they said effective December 1st, we are not going to be letting the proceeds run off. We're going to reinvest the bonds that mature by buying new ones to try to basically keep rates low. But that is not contributing to disinflation. If anything, keeping the balance sheet that big contributes to inflation. Here's a graph of the balance sheet. We were always under $1 trillion. Then we had the 2008 financial crisis. It grew to $2 trillion, which was absolutely massive. And they kept it growing all the way to try to get us out because the velocity money was so low and because inflation was well below that 2%. And we kind of leveled off around $4.5 trillion. And it took 10 years to be comfortable enough to say, okay, we're going to let that balance sheet run off now. And they started doing that and they were making progress on it. They got below $4 trillion and then COVID hit and they took that thing all the way to $9 trillion. Today we're about $6.75 trillion. They have de-printed about $2 trillion there, and they are stopping. So we'll see if they ever get back going on that. But that is not an inflation lowering or a disinflationary development by any means. We also had a lot of development last week in international trade. Probably the biggest and most consequential is that the USA and China, President Trump and President Xi Jinping, reached a very significant agreement. Number one, China will pause the limits that they recently imposed on very important magnets and rare earth minerals that the U.S. needs for its economy. China will also drop antitrust actions against U.S. tech companies. That's important. The U.S. will reduce certain tariffs on Chinese goods. Important as well. That will help with inflation. China is committed to reopen and expand market access for U.S. soybeans, and there was even a specific dollar amount purchase, which American farmers were very happy with, and other farming products as well. In addition to the China deal, the U.S. announced agreements with Malaysia and Cambodia were signed. A framework was launched for agreements with Thailand and Vietnam, all the above aim to expand U.S. market access abroad. South Korea welcomed a new trade and investment agreement, and the U.S. updated and signed a new agreement with Japan. So those were all positive, right? These are growth positive things. If they all happen, the level and the depth at which they happen are all growth positive, GDP positive. If you narrow a trade deficit, you increase GDP. So that's the U.S. trying to outgrow its debt problem that it has at the sovereign level. At the same time, there were some trade problems and tensions last week. UK, that's the United Kingdom, small businesses said, hey, we're not benefiting from this new agreement, lots of red tape. We have lingering Brexit challenges, so that perked up last week. And those who follow the China situation closely said, look, this is China and the U.S. Anything is fluid, anything could change. Retrading by both sides is always possible, and that could cause a risk on trade, which would be a big drop in the market. Right now, we have kind of a risk off trade because it looks like we have a great deal with China, and we do. Whether or not it holds, sticks, etc., is all still on the table. We're well into earnings season now. 317 of the 499 or 500 S&P 500 companies. 261 have beat on the earnings estimate. 44 have failed to beat. Average earnings surprise, much smaller than in recent quarters, but good nonetheless. Everything looks pretty solid. Lots of economic data this week. When we get in the first week of the month, there's always plenty. We've got S&P Global Manufacturing PMI along with ISM's PMI, one above 50, one below 50. We don't know about construction spending. Automobile sales we'll get later today on Monday. We won't get a trade deficit. Job openings we will get. The JOLTS report looking at 7.2 million roughly. We won't get factory orders. These question marks are all related to the government shutdown. ADP jobs report. Remember last month they said we lost 32,000. We need a positive number. That's right on the zero line, 27,000. Then we get the services PMIs, both expected to be above 50 on Wednesday. That's positive for the market. Weekly claims for unemployment, estimate is 224. I doubt we will get a report. Productivity, labor costs, and then the BLS payroll and unemployment, that will be not happening because of the shutdown. Consumer sentiment looks good, and consumer credit looks very good as well. Thanks, everybody, for tuning in. I will be back to you again in 1 week.